Hi, in this video, we will see the treatment of existing goodwill, that is goodwill that already appears in the books. Let's understand the meaning further. What is the meaning of existing goodwill? Existing goodwill refers to goodwill which is already recorded as an asset in the balance sheet of the firm. So in the balance sheet of the firm which is given, goodwill already appears as an asset, and this goodwill is referred to as existing goodwill. Now in small sums where the balance sheet would not be given, the phrase goodwill appears in the books as rupees XXX will be mentioned. Goodwill appears in the books at rupees XXX. So this existing goodwill is purchased goodwill. Since as per Accounting Standard 26, only purchased goodwill is recorded in the books of accounts. Self-generated goodwill cannot be recorded in the books of accounts. And since this goodwill is already recorded in the books of accounts, it has to be only purchased goodwill. Now, what is the treatment for this existing goodwill that already appears in the books? Treatment of existing goodwill. Existing goodwill is to be written off among the existing partners in old profit sharing ratio. We'll see the journal entry for writing off this existing goodwill. The journal entry for writing off existing goodwill depends on whether the fluctuating capital method or the fixed capital method is being followed. So let's begin with the fluctuating capital method. So this method is to be assumed in the absence of information. The journal entry for writing off goodwill, existing goodwill, is old partner's capital account debit in OPSR to goodwill account. We need to credit goodwill account with the amount of existing goodwill and debit it among the partner's capital account in old profit sharing ratio. Narration being existing goodwill written off among the old partners in old profit sharing ratio. So again, we need to credit the goodwill account with the amount of the existing goodwill and debit the partner's capital account, the old partner's capital account, in their old profit sharing ratio. What if the fixed capital method is being followed? In this case, after crediting goodwill with the amount of existing goodwill, the partner's current account needs to be debited with the amount of existing goodwill divided among them in old profit sharing ratio. Narration being existing goodwill written off among old partners in old profit sharing ratio. When we talk about change in profit sharing ratio, there is no such thing as old partners or new partners. When I mentioned old partners, I am referring to the partner's capital account in old profit sharing ratio. And when I say new partners capital accounts, I mean the same existing partners in new profit sharing ratio. So we saw how existing goodwill or goodwill which already appears in the books of accounts or goodwill which appears as an asset in the balance sheet of the firm is treated. In the upcoming video, we will be doing example sums to understand the concept of treating existing goodwill better.